Let's bring in Ann Sonders, Charles Schwab, Chief Investment Strategist. Ann, I know you've been listening to this conversation. A lot has been written about the line from NVIDIA to, say, manufacturing construction to productivity and what that does to real rates over time. Are you a believer?
Long term, I agree with what David said. I think this is a very positive long-term productivity story. I'm just not sure you can yet connect the dots to what we've seen in productivity improving as being either broadly about or very specific to AI. I think that's coming. But also to your point, you've got NVIDIA, and it's 40% of its customer base is represented by the small handful of companies that are also within the Magnificent Seven. And I think that's been the market story. But under the surface, there's obviously a lot more churn in averages, particularly like the NASDAQ, where the average NASDAQ member has had more than a 20% drawdown from a year-to-date high. You don't see that when you just look at the averages because of the dominance of names like that.
Right. What do you make of, I was talking to Jim earlier this morning about how we were sort of supposed to be mired in this seasonally weak period. The number of rate cuts has been coming off, and yet here we are at record closes. What does account for it then?
Well, this is going to be the interesting thing to see how much of the market's overall gain is a function of Fed rate cuts. Now, even before the hotter CPI report and the better than expected jobs report, we, as you know, Carl, we were not in the camp that felt that March was the start point. I think that the market had gotten a bit over its skis, not just with an early start point, but 6 or 7 rate cuts. And the market obviously has come back to where the Fed sits right now. But I'm not sure that that just translates immediately into, okay, they'll cut in May and it'll only be 3 times. A data-dependent Fed means we're at the mercy of the data. And I think really key in the PCE report, Sarah talked about the 3-month change, the 6-month change, which historically has been what the Fed has focused on, not just the most recent point number, but less so at the most recent press conference, but specifically at the 60 Minutes interview that Jay Powell did. He talked about a 12-month change. I think that was just another way to talk about they want to see an extended period of time where that disinflationary trend is intact. And so that makes those 12-month numbers, I think, a little bit more of a tell with each inflation report that we get, PCE or otherwise.
Are you fielding questions, Ann, from clients about dot-com bubble? I mean, I can't tell you how many charts are being passed around now that are comparing NVIDIA to Cisco back then, or comparing the market cap growth of NVIDIA to other, big tech companies during the internet bubble. What do you say to that? Tons of questions.
And you can certainly point to a valuation problem, but the underlying strength of these companies in terms of cash flows and profitability is starkly different from what was going on, not across the board in the late 1990s. You had strong tech companies that still exist today that are large and meaningful, but you also had so much silliness at the time and, valuations on things like eyeballs and really no prospects, certainly with the benefit of hindsight, of profitability in a lot of these companies. That's not the case. That doesn't mean you don't end up in a valuation bubble of sorts. But I think that the denominator of this equation in this environment is, I think, the most stark difference relative to the denominator in the equation back in the late 1990s.